What used to be the middle class is no longer. If you buy a $400,000 house today, without the payment now, okay, just the insurance and the taxes, it's about $1,500 a month before you ever make the payment. And if you look at real wages over a 20-year period, 25-year period, they have not gone up. So, it's been great for Wall Street, and it's been great for all those CEOs and everything that cash out every year, but it's not been great for the average person. And I think that's where we missed our way here.
Ted Oakley, managing partner and founder of Oxbow Advisors. It is such a treat to welcome you back on the show. I feel like you are a friend of this show, and we love having you on. Great to see you as always, Ted, and thank you for taking the time today.
Well, Julia, I'm always happy to talk to you. I've been so impressed with your success. You keep gaining ground. It's very impressive.
Well, that means a lot. And you've certainly been part of that success story, just having you on twice. And you were definitely one of the fan favorite episodes when we got to do the in-person episode in Austin. And I hope we can do another one of those again soon. And Ted, I feel like, gosh, so much has happened since we last had you on, which is coming up on a year now. I would love to start where I always start with my guest, and that is just to get the update, that big picture, macro view, the framework in which you're looking at the world today. And one of the things, as you know, Ted, you can take all the time you need to set the table when it comes to that macro picture.
Well, Julie, it's been a slow disintegration. I mean, I could show you 30 things right now that have slowly disintegrated over the last 12 months in terms of economic things. You can just run down the list, though, amidst delinquencies and credit cards and real estate and commercial real estate. There's so many things I could add to that. The work week's down and unemployment up a little bit. There's about 30 of them. And the thing about it is it's been a slow disintegration, so people don't really recognize it too much. And if you look worldwide, a lot of countries are really declining worldwide, and we've been a standout, but I think we're really sort of faking ourselves out because we're in a situation where we're not going to be able to be, I think at least, to be able to sustain it. And we've had the last 15 years, people have gotten used to the Fed saving us all, and I just don't think they can do it this time. Maybe for a short period of time they could, but as far as what the economy looks like and what that's brung with it really is higher stock prices, believe it or not, in a worsening situation. So we really still have a lot of companies. The big companies are really overvalued. And so that's where the market is right now, and the concentration's still there. So not a lot changed in the last 9 or 10 months, but that's the way we see it.
Yeah. You mentioned folks still have this kind of idea that the Fed will be saving everyone. Can we just step back and talk about the Fed? We have the meeting coming up in September. Lots of talk about a rate cut. Just would love to kind of get your take as it relates to the Fed.
Well, as you probably know, I'm not a big Fed fan. I mean, I think they always do the wrong things. And I've not watched the Fed for 40 years. So really after Greenspan, they sort of lost their way and it just got worse and worse and worse. And now I see them really running a Federal Reserve that's sort of tied to the stock market. Crazy as that sounds, I think they look at that and unfortunately where the stock market used to reflect the economy, now the economy is reflecting the stock market. And I think that while it's not a mandate of theirs, I think that's something they keep up to the front. And I think there'll be a spot where they can't do that anymore. But normally when they start lowering rates, it's not a good thing. I mean, I could show you over the years what happens, and you'll get a short-term pop, usually a few days, and then people realize why they're lowering rates, which is things are not going so well. I think that's what will transpire over that period. The other thing that might catch them, unfortunately, is you're not necessarily out of the woods with inflation, and if you lower the rates in here and you kick it up again, then they're right back where they started. So I think they got a tough job, but they put themselves in this situation, so they'll just have to deal with it.
Yeah, you made an interesting point about them being so tied to the stock market. I mean, wouldn't that just mean their policies only benefit a certain portion of the population, like the asset holders who've really even actually probably benefited from inflation?
No question about that. I mean, I've said it for years that this whole group of people after Greenspan have done nothing but set up to people to have asset prices at their level, stocks, real estate, you name it, companies be priced at a higher level. Well, 3 out of 5 Americans right now think we're in recession. They don't feel that. They don't own that stuff. So for them, it's a tough life. And what they've done is just exaggerate the difference between the haves and the have-nots. And that's not a good thing for a country. If you look at countries that go into demise, it's where you blow up the middle. And then the lower class ends up eventually revolting. Mm-hmm. And, it's something along that line. And you call it different things, but that's usually what happens.
What do you think like you mentioned the middle class, and that is like literally the backbone of the economy. What is kind of your thought or assessment of like the state of the middle class today, like where we are today?
Well, I think what used to be the middle class is no longer, because what's happened is, you've had to go to where you have 2 earner families and sometimes working more than one job. And if you look at it today, for example, just give you an example. If you buy a $400,000 house today without the payment now, okay, just the the insurance and the taxes, it's about $1,500 a month before you ever make the payment. What we've done is price all these people out of what could have been the American dream. And if you look at real wages over a 20-year period, 25-year period, they have not gone up. So, it's been great for Wall Street, and it's been great for all those CEOs and everything that cash out every year, but it's not been great for the average person. And I think that's where we missed our way here.
Mm-hmm. Okay, so going back to the Fed, if they cut rates, it's definitely not a good sign, or it wouldn't be a good sign. Do you think they're going to cut in September?
I could see them actually, because these numbers keep getting worse, you see. And so we've got another 3 or 4 weeks of numbers. And I think as those numbers get worse, they will look at something like that. And I could see them sort of spook a little bit and say, well, maybe we ought to do a 0.5 point. That wouldn't surprise me. But when they start cutting rates, look at it this way. If it's an 8.5% prime rate and you only cut the rate 1/4 to 8.25%, that's not going to make you as a business go out and borrow more money to build a building or do something. It's just not enough. Mm-hmm. You've got to get into a point where, you have at least 6 or 7 cuts, 8 cuts to make it worth the business person to go out and decide, hey, I want to take on more debt. It doesn't do, even if you cut a 0.5 point, you've got an 8% prime. Prime plus 1 is 9. And that does not do the average business owner a lot of good.
Mm-hmm. Well, I have to say, like, one of the things I love talking to you about is just like, because of the work that you do at Oxbow and the type of clients you have, I imagine you are having some really interesting conversations about the state of the economy and, conversations about like, what would that even mean for a business owner? A lot of these folks are business owners that you work with. What are you hearing from clients as it relates to the economic picture? Maybe some interesting anecdotes that you can share.
Well, one of the things you're finding, and I see this in particularly most of the South and Southwest larger cities, is you're having a lot of big commercial credits that pay, a lot of rate per month. Let's say they pay over $100,000 a month, $200,000 a month, and some of those are walking. And they're just saying, hey, come after me because we're not making any money. So, we're out of here. Well, that means 30 days from now, they'll close the doors, lock the key, and that business is done. We're starting to see more and more of that now. And we're starting to see, and people don't realize the trickle down effect that happens when you start shutting businesses down. And you can see bankruptcies up big this year. You start shutting them down, and we're hearing the customers we know that'll do well are not leveraged. Leverage will be the problem in here. And most of the people that'll do well are not highly leveraged. And that's always the case, but it's really the case now because a lot of people are really leveraged. And I just don't think they can get through this with all that leverage.
Mm-hmm. Yeah, that's a good point. A lot of bankruptcies up to, and the leverage situation. How about going back to the markets? I'm thinking even last week, we saw quite some turbulence with the yen carry trade unwind. What did you, when that went down last week, what were you all talking to clients about? Like, what was kind of your assessment of it? Is it a warning sign of trouble or things to come? Just would love to hear, just what folks were asking you about.
That's a good question, Julia. For us, if you look at our three strategies, we average right now about 55% in Treasury. Mm-hmm. So we knew it wouldn't affect us a lot. And it would affect the stock. We only have three strategies. The strategy that has stocks, it would affect some. But we actually went the other way because we own things that weren't so tech. We own tech too, but we own a lot of other things as well. And that made it a plus, but it just wasn't deep enough. And it was interesting that in the midst of all of that, the buy the dip came back, roaring back. I mean, it was like a few days and see, people in the last 15 years, all the practitioners in this business that just came in that period, and all the people are just in this mode of, we have to buy the dip because it's always worked. Well, it's probably getting ready not to work, but that they keep pulling them in with that. And of course, naturally, it popped back up here again, but not to new highs. I think that's what will throw them in here. But that's sort of the thing that went on. Our particular investors didn't have a hard time because the way we're balanced, it will affect us, but it's not one of those things where we're, 100% stocks or something. And so I think that's where the average person right now is too high as far as allocation to stocks. Mm-hmm. And so things like that really affect them. And I don't think they're ready for an extended downturn or an extended recession for that matter. So that's the difference really between what we do probably and a lot of people.
Mm-hmm. Yeah, the average person, their exposure is too high. I want to hear more about how y'all think about building portfolios for your clients. Because I imagine a lot of it is how do you preserve and stay wealthy as well?
Well, a lot of the people we do business with, they had a liquidity event. Most of them sold a business. A lot of them did, I should say. So they don't want to go backwards. And so we really stress balance in an account. Now what does that mean? That means that we're not going to be out there trying to take that whole account and beat the S&P because that'll get you in trouble. But what we do is we run a balance where we have portion that's really conservative. It really doesn't change at all. It doesn't make as much as the others. Then we have on the other end full stocks. In the middle, we have something called high income. So we balance all that out and look at it right now just across the board. That's because we don't have enough things to own that are cheap. We're very high cash. We're not like a Warren Buffett that has $250 billion, but we have more than we've ever had, which is probably 54% in the Treasury. But we're making 5.25 on it. So it's not not the end of the world, and that's how we protect it. Because when you get deep selling in a market, and I'm saying there's something more than 20 or 25% or more. If you don't have any liquidity, you can't see. We see that as an opportunity, but if you don't have any liquidity, it's not an opportunity for you. You're scared because you're thinking, I'm getting hurt here. So we have a different view on it, and I know people think that we look at it differently, but it's what we do because that's what you can settle down in these markets that really come apart and stay a steady period. I think you could get more of this. I don't think last week it was like a sneak preview. And when you get that, if you have liquidity and you're balanced, you got to be balanced, you'll do fine. And you'll make some really great buys in stocks, and that's really what it's all about, because we like to own those things 5 to 10 years. So we're going to buy them right, and we can't buy them right. We just don't buy.
I like that. Okay. So y'all have more cash than you ever had, 55%.
We had to just about that much, I would say to you, in 2000.
Oh, interesting. Okay. Well, we know what happened in 2000.
Yeah. So we had about 48 to 50. We lost some accounts in 99. Because we sold our last tech stock in March of 99, and that had a big year that year, and the market, it was really overpriced. It paid off though, because, in that whole bear market, it was a 50% plus bear market. I think we were down 10 points. it's not that we're such geniuses, but you have to have the ability to safeguard the downside. And I think that's left people's minds today.
Mm-hmm.
I think they're not thinking about safeguarding or preservation, and we believe they will, and it'll be different for them the next 5 or 10 years. And so that's sort of where we are. We also own gold too, own about 4% gold. So that's another thing that fits in with us.
Well, gold's been moving lately too, and I will come back to that. But just going back to you mentioned going back to 2000. Do you see similarities between those two periods, or between now and then, from an investing perspective?
Well, we had a lot of concentration then, but it was in about 15 companies, not like 6. That's one of the differences. The other difference is we didn't have so much passive investing then.
Mm-hmm.
So you had a chance to go against the grain a little easier, but they were obviously too expensive. The multiples are even higher in many cases than they were today. The difference today is we have probably 40% of the Russell 2000 that are losing money. We didn't have that so much back then. So you can't jump over to that. And then the second thing is that you always get this where people drive into one group of stocks and they think that's going to be the group for the next 20 or 30 years. And they don't realize these things have about a 10-year life at max, So, it's just different, but it's a different set of stocks. Cisco was the hottest stock there was. It went from 82 to 8. So they all did the same thing. Dell, Intel, I wrote a piece in January of 2000, and I said, these 13 stocks are going to hurt you. Mm. And believe it or not, every one of them went down. The best one went down about 30%, and a half of them went down more than 60. Now, you can write about that because everybody owns the same thing. There's nobody left to buy it. See, that's what happens. And that's what's wrong with passive right here. They're all in the same thing. So if they go to sell, they're going to sell the major big companies, which make up the big passive, and it'll be like a trap door. There's nobody to buy it because they're already in it.
That's a good point. And that conversation has come up on this show as well. It's almost interesting. You've been in the markets for over 40 years, just the evolution of it and the rise of passive. I reckon also algorithmic trading. I am curious, how you've seen these kind of forces evolve over time, and has it just made it, does it make it more challenging? Does it create more risks? Even the rise of the retail trader as well. But I am curious.
Well, I think what changed everything was when we went to decimals instead of fractions. That fractions settle the markets down a lot more than decimals. Decimals, think about it, you make a penny and you break even. And so, before you had to make a half. And so that changed the market a lot. But then, all algorithms, black boxes, everything, everybody got closer and closer and wanting to have the newest thing. It does get back to, you can take this back over thousands of years. Whatever creates cash flow is what you have to look at, because in the end, that's what makes a great buy, no matter what. Real estate, a private business, oil and gas, it has to be cash flow. And what we've done is we created so much money since 2015 that they bought everything, and it didn't make any difference about the cash flow. And that's where we are today. And I think that's what will confuse people. They'll say, well, the big stocks have cash flow. They do, but they're slowing down. That's, that rate of change it's positive absolute year to year, but rate of change is negative. And that's the way these things start. And, and you'll see companies that you thought was the greatest company in the world. And, it comes apart on you. It doesn't mean that it's not a good company. Cisco's a great company. But it's still 50% of what it was in 2000.
Yeah. So going back to the positioning and having that sizable cash position. Also, as you know, Warren Buffett also has a large cash pile. Are you doing that in anticipation for a recession, a market correction? Would love to kind of put a bit more meat on the bones, how you're thinking about, the cash position, maybe future opportunities when we see things pull back meaningfully.
We had a lot of the cash, Julia, in a floating rate U.S. Treasury, which resets on the 90-day rate every Monday. So you can't go up or down on the principal. And it was all yielding 530, 540, and that was fine. Starting about 3 months ago, we thought that we're going to come into this period where things are going to slow down. Whether you go into a deep recession or any recession, we don't know, but we do think the rates are coming down. So we pushed some of that money into 6 month, 9 month, 1 year, and 2 year. Anything we could still get 5% on, we locked it, and for that point of it. Now, we don't own a lot of long paper because we believe the next 10 years you're going to have to keep your maturities less than 60 months. But we did do this on a trade, and it's just a trade. When we had the 30-year really low about a month ago, 5 weeks ago, we did take a 5% position in it. And it's done nicely, but we only want 10 or 12% out of that trade because that's what will fit with that category. And when we're done with that, we're done with it because everything else for us will be less than 60 months. But we tried to lock. We tried to move a lot of that money out and lock. And so now, just to give you an example, you can barely, it's just barely under 5 on the 6 month. On the 9 month, you can't get it. On the 1 year, you can't get 5. On the 2 year, you can't get 5. So see, what we tried to do was lock those up. And if we're wrong, and we could be wrong, but if we are wrong, we only have to own them for 1 year or a year and a half.
Yeah, that's a good point too about just like how long you want to own this paper. Because like in recent weeks too, I'm looking at the 10-year Treasury right now. It's 3.864 as we record this, but we saw it fall below 4. What's your take on the movement that we've seen in the 10-year, and what does that signal to you? How do you kind of read into that?
Well, I think what's happening is if you look, I think what the Fed would like, if you look what the Treasury, I'll use the Treasury as an example. The reason they haven't been selling, in my opinion, any 30-year paper to speak of, it's mostly been T-bills, is because they don't want to affect that long market any more than they already have. Now, that's personal opinion. But what's going on in the short end, you'll look at the reverse repo market is declining because everybody's seeing the same thing I just talked about. And they're going out and said, hey, I'm not going to buy that bill anymore. I'm going to buy a note. I'm going to buy a 1 year, a year and a half. I'm going to try to lock that in too. So there's been a change on that. And I think what happens on the 10-year, and this is something that I think people need to realize, that once you go past 48 or 60 months, then for somebody to offer us, for example, 386 for 10 years or even 425 for 30 years, that's not a good trade for us right now because we think it might be on a short run, by the way. That's what I say for a trade. But the point is that if we're going to inflate and we think the inflation rate will just be generally higher the next 10 years, then we think it's going to be at least over 3. Well, if that's the case, you don't want to own the 10-year to 386. See, it doesn't make sense. And we have to pay tax on it too. So, not state tax, but Fed tax. So that's why we look at things like that. And I can buy, like we own Kinder Morgan and an Allstate bond. It's about 4.5 years at a 501 or 502%. We can do that sort of thing, but that's about as far as we're going to go right now.
Yeah. All right. How about in terms of opportunities? You have this cash position, which you mentioned being in short-term paper. You also mentioned gold too, but when you think about how y'all want to be allocated, where are the interesting opportunities for you all today, if you can share?
Well, during poor times, you want to own a different set of stocks. You will see we added a lot to healthcare. We added to utilities. We added 1 or 2 real estate investment trusts. Those are the things that do better during slow times. And you want consumer staples, not consumer discretionary. And that's where we've added and things along that line. We still have legacy holdings, not to a great degree. We've cut them back 3 or 4 or 5 times. But you'll see we still have legacy holdings in Google and Apple and Amazon, but they've been cut back, and we have such big profits in them. We're not going to sell the whole thing, but they're becoming less and less of what we're doing. And the new buys we make are just they're not they're not in not in those categories. They're in a different space, and drugs, I should say. We've been able to buy some drugs back on cheap levels, Merck, Roche, things like that pay good dividends, and that's kind of where we've gone, and we already own the gold miners and the gold, and so we for new accounts we'll buy it, but generally we have what we want to have in that area, and so that's where we've been.
Do y'all play gold? Do y'all do any of the physical gold, or do you just play the miners?
Well, in two of the strategies we own the physical, and here's why. I think people look at gold the wrong way, Julia. Let me give you an example. They think about it like, well, it doesn't pay any income and this, that, and the other. But if you'd go back 20 years at 2004 and you look at the average price of a home was $175,000, and gold was about $418 an ounce, right around there. I just ran these numbers last week. That's why I know. It took you about 425 ounces of gold to buy that house, 425 ounces at that price. If you had kept that 425 ounces of gold today, the average price of a home today, which is something around, 460, 70, but that gold is worth $1,070,000. The same ounces, just the same ounces you have. And I think that's why people don't realize what gold does. You can say, well, it doesn't pay you any income. That's true. It doesn't pay a lot of income, but if you're going to hold it, you got to hold it a long time, and you have to be willing to go through 3 or 4 or 5 years when it's not going up, because it's not going to go up every year. But the basis of it is this, and that is over time, 10 years, 20 years, 30 years, it's a piece you can hold, and that's how it will make a difference. Now, the miners you trade. They're cheap right now, and so we own the miners. We own Agnico, Newmont, Royal Gold, and they're cheap, and they've done well, but they probably have more to go in time in here. But they're different than the bullion. You can own, you just keep it. The miners, at some point you have to trade them, sell them. It's not something you're going to own for 20 years.
Yeah. Do y'all have like a framework, Ted, well, I imagine you do, but I'm curious. When you're talking about like certain positions, like I was looking back in my notes, we're talking about y'all still own Google, Apple, Amazon. You have big profits on those, their legacy holdings and whatnot. When do you want to sell, or do you have a framework of like how much you sell so you can still benefit from owning it? I don't know if that's a good question, but I am curious. When do you decide? Yeah.
You know what, Julia, that's an excellent question, because the average investor has some trouble with this too. Maybe they own one of these that's done really well. Maybe they own NVIDIA, and they put 50 grand into it, and it's worth, 800. That kind of thing. They have to decide, okay, here's what you have to decide. You sell it. If I sell it and I pay tax, and the tax is going to be 23 points roughly with Obama tax plus state tax, am I going to get a setback in that stock big enough that's going to be greater than that? Because if it's not greater than that, you don't want to sell it. See, in other words, you're trying to net out here. And in most of those cases with those big names, the reason we take them down is because eventually they'll have more than the tax move down. And so we want to get our cost out of it. That's a big thing we look at. If we get our cost out of it plus a return, then we're willing to ride with it then at that point, because we don't have anything in it. And that's the way we look at those big names like that. But we continue to cut them back, as they move along. And so it wasn't surprising to me that Warren Buffett sold a lot of Apple either. That's kind of the same thing.
So that wasn't surprising to you. Do you think he was doing the same thing?
Oh, totally. First of all, we wouldn't have had 48% of the portfolio in one stock.
Yeah.
That's not like that fella, and I've known about him, for years and watched him. It's great. But I wouldn't be surprised if he's not selling some in the third quarter. We don't know that yet,
Mm-hmm.
but I wouldn't be surprised.
Yeah. Yeah, that was a massive position. And I think that actually surprised people when he got into it, but I think it was either Ted or Todd. I can't remember which one of the investment deputies made the recommendation there.
No, I think I've always said one of the other people gave me the idea, and it made sense. I mean, this company produces a lot of cash. To a degree, we own it, but to a degree, it's a one-trick pony. And, there'll be a time when, I remember things. Remember the BlackBerry? I mean, there's so many things like that. I mean, I remember MySpace.
I remember MySpace.
At times, there's things that pop up and you think, man, this nobody's going to replace this. And it doesn't work that way. I remember a quote. I saw this last year. Jeff Bezos said, there'll come a time at some point in the history where Amazon won't be doing that well.
Yeah.
And that's if we go back, I collect stock certificates and I've got hundreds and hundreds of them. And if you go back and look at the decades, back 20s, 30s, 40s, 50s, they're not here. A few of them are, but not many.
Yeah. Yeah. I've actually never even looked up, what's the oldest publicly traded company that's still around? I have no idea. Couldn't tell you.
Well, I don't know. I have to say I don't know. I know it's going to be one of the Dow stocks probably, but maybe not. It might be something else. But it's hard to keep it like that because, things happen over time and different managements, all sorts of things.
Yeah. You mentioned in the conversation earlier that a lot of folks, they're not thinking about the preservation of their wealth, or they're buying these things way too high, getting into it. The way you run your firm, the way you manage your clients' money, where did that kind of approach or influence come from?
Well, it really came from about 1983 on, because we started working with people that sold businesses then. And the business owner, I love business owners because they've taken all the risks. They do a lot for their company, the people, the community. But when they sell it, one of the things that they want is makes sense, is they really don't, like if you sell a company for $25 million, you don't want to get up next year and find out it's worth $15 million because you've already paid tax on it. So one of the things we had to develop was a system where we could have a great return, and we want to return a few points over inflation because that's how you're going to keep buying power intact, but not get caught up in the idea that I need to beat the S&P, because if we just wanted to do the S&P, you could put it in the S&P. The problem for most people with a lot of money is that they can't take the 50% drawdowns and the 35% drawdowns because they don't need to. That's the point. I mean, if you have that much money, you don't need to take the drawdown. And that's sort of the market we're in, or we're after. And they don't have to make that last buck. They've already made it. And I think now that's a totally different situation than the person that only has $1 million and they're really trying to get a lot of growth out of it. I understand that. We're not for everybody, but I even think the people with smaller amounts of money need to think about staying balanced, because most of them today are not really balanced at all.
Yeah. Well, that's what you wrote your book on that, staying what was it? Staying rich with a balanced portfolio. Oh, maybe get the headline.
Yeah, that's it.
That's right. That's staying rich with a balanced portfolio, which is, yes, that is the name of the book. Stay rich with a balanced portfolio, which was key.
Well, I'm writing a harder one now. I've been working on this for about a year, about second and third generation wealth.
We got a little taste of that. It was so interesting. And when we were together in Austin, as you're writing that, any other revelations about, second generation, third generation wealth? The thing about it is I've been around a lot of great people that had great families, and I've watched this over time. It's one of the hardest things for people with a lot of money to do. Very hard to decide how you're going to maintain that wealth through the next second, third generation, but still have these offspring so that they are self-sufficient, they have self-esteem, they've had to make it out on their own for a while. It's hard. It's a very hard thing to do. And every child's different too, see? So
it's one of the hardest things I've ever written about. I'll be honest. I've been spending a lot of time on it because everything's a little different for each family. And I know the things that work and I know the things that don't work. I will say that, but it is different, and it is different for each setting. I really have a soft spot in my heart for people that are trying to make that work, because they know that if they do it right, that second and third generation will still have money. And really a lot of third generations, Julia, they don't have money.
Mm-hmm.
They spend it.
Okay. So what's an example of someone who does it right? And then what's an example of someone who's doing it wrong? You can anonymize it, obviously.
Yeah, and these are generalities, by the way, and I'm not an expert. I'm just going to tell you what I've noticed over many, many years, that the person that does it right they don't try to change their lifestyle so much while the children are at home. So they see this extravagance that goes on, and all of a sudden money doesn't mean anything to them. They take the people that do it right, they require those children to, number one, work. Almost all of them make them work somewhere, do something. They won't let them just freeload. And so they make them work, and they put them out on their own for a while. Before you come back to that family office or whatever, let's push you out there for a while for 5 to 8 years, 10 years, whatever works. And let's see them have to make it go. And that's when they learn the real things of life. What's money worth? What's expensive? What's not expensive? What if I run out of money? Those things work, and they do that with those kids. That's one thing I noticed that they do. And they don't overspoil them. I will say they do some things. They put them through school, typically through college, with no debt. I think that's a plus. But they don't buy them new BMWs and Mercedes. They're still driving an old 4Runner they've had for 10 years. That's one of the differences. And in the summers, they have to work. They don't get to go to Aspen. They don't get to go to Europe. They have to keep that going. And I think what's hard for parents with a lot of money is that they had it tough. They had to work really hard to get where they got, and they're almost like, gosh, I don't want to see them have to hurt that much. But in a way, they need to hurt that much. Mm-hmm. They need to know what it's like to not be able to get everything. Now, on the other side, the people that do it wrong I see this quite a bit. They have a lot of money, and it's just not worth their time, and they just basically give the kids anything they want, and they don't have to do anything. And they end up, I've always told people that we do business with, I said, I know you have a jet out here, but these kids are only 16 or 17 years old. So I'm giving you just one little piece of advice. Fly them on Southwest or wherever you're going. In coach, check the bags, make them go through the airport, do all that kind of stuff, okay? Make them understand what goes on in the real world. Mm-hmm. Don't send them to Cabo, at spring break with 8 other kids. Try to think about lifestyle here, because if your lifestyle is such that you're doing nothing but buying material things all the time, that's the example you're setting for that child. So those are the ones that I know work and don't work. Now, there's a lot of things in between too, I will tell you. And it depends a lot on the kid. And a lot of parents, want to take their drive and push it into a child. And a lot of kids they're not like that. They want to be a musician. Okay, well, that's okay. Have them work at it and be the best musician, whatever they want to do. But I think a lot of times you take parents and they're like, they make children feel less than because they don't have the drive that the matriarch or patriarch had. And I think that's negative too. But it takes a lot of work. I have my hats off to the parents that do it right, because I've seen a lot of great ones too that do it really well.
That's going to be a fascinating book when that one comes out. Yeah, I've seen the spectrum too. Maybe I can compare notes of like how folks have done it. I want to end. I've never asked you this question, so I don't know where it's going to go. But I'm curious, as someone who's been in the markets for over 40 years, what was your best year And what was your worst year? And what did you learn from those experiences?
Well, my best year was 2009. I was up 165%. And I knew what happened then, though, is everything was so cheap. By the first quarter of 2009, you didn't have to be a genius. I mean, we had things that were yielding 15%. You could borrow money and make it work. Everything was so cheap. And one of my worst years was really when I was younger. And never forget this. I didn't see the change. The market in 1982, August of 82, bonds peaked and started down. And that's when the new bull market started. Now, in the period I'd been in the market before then, every time the market went up to 1,000, it went back to 750. This went on for like 15 years now. This is what I'm talking about. You get used to something going on. And so I missed out. I was a little invested, but I missed out on that move between 1,000 and 1,350 or 1,400. That's a lot, okay? Because it kept thinking it was going to go back the other way. And a number of other people too. I mean, Joe Granville was the hottest guy calling the markets in the 70s. And he got killed then because he went short and never could reverse, okay? So one of the things I learned about that, is learn to reverse. You don't know everything. And so when it's going against you, you need to stop and think about what's going on, because if not, you're probably going to get hurt more. And so those are the two worst and best times I ever had.
I imagine then you have to kind of like recognize like the bias that comes with the markets, or like some people get used to certain environments or ways that things have been, but they don't always play out the same way.
That is so true, Julia. They go deeper than you think, and they go higher than you think. And that's why people ask us, well, if you don't like the market, why don't you just go 100% in treasuries? And my answer to them is always the same. Well, we're not that good. I mean, you don't know where that ends. And so even though we know things are high, if we have, 45, 50% in companies, we're still going to do well. Mm-hmm. But we also have a situation where we have something to lean on if we do the other. And I think you have to be able to give yourself a lot of choices in investing. And I always look at down markets as opportunity. I know people, I promise you, when people are so down and out, you'll see us sort of excited.
Oh, yeah.
Because that's when you get really get opportunity. And, it might not work out for the next 6 months, but it'll eventually work out. I remember we had about 40% liquid in the 2008, and the market went from about 14,700 to 8,800. Okay. That's a big move.
It's huge.
Yeah. We put in about half the money. Now get a load of this.
Okay.
By the time we got to March, this is only 4.5 months later, March of 2009, it was 6,600. We lost another 2,200 points. So we put the other money in, and by the time we got to believe it or not, by the time we got to the end of 2009, first quarter of 2010, we were at a new high. So you're not always going to be right, but you know when you're in the zone, I should say.
I like that. Know when you're in the zone. I think, would it be fair to say y'all are positioned like defensively? Is that how you would best characterize it right now? Like having the cash position, some exposures, equities, gold. Is that the best way to?
Well, yeah, and I would say more balanced, really. Mm-hmm. If you look at it, we have this something we compare against is we take the aggregate bond index, then we take the high yield index, which is a higher cash flow, and then we take the S&P 500 and mix those together, and we measure ourselves against that, okay? And so we have about 53 or 54% liquid right now, and we're still over 80% of that number. Now, that's the way we view success, because if we can be really up on that number, but not be fully in, that's how we view it.
Mm-hmm. Ted, I always love having you on. I love listening to you. I love learning from you. I want to give you the final few minutes here, and actually you can take all the time you need, but just you can, if you want to share more about the work that you all do at Oxbow Advisors, Anything else that you'd like to plug, and maybe some parting thoughts, something you'd like to reinforce from this conversation, maybe something that we didn't bring up that you would like to leave with the audience to think about. The floor is all yours.
Well, the one thing I see today, Julia, that would concern me is that there are a lot of people over 60 years of age, and we see these portfolios, so I know this, that are 85 or 90% stock. And they've done really well. Don't get me wrong. They've had a 10 or 12 year run here. Most of them don't know what they own, or they own one or two stocks that have done so well it's blown the same thing up. And I think those people, and I see it with people 70, 75, even 80 years old. And the thing I would bring to their attention is this: you will go through periods that will really test your ability to stay in there. And most of those people probably won't. So why lose that money? Try to make it such that you have a little more balance. And that's the one big thing I see in the marketplace today. Now, if you're 20 years old, you're going to make more money the rest of your life. And so that's something to keep in mind and go with that. And that's the number one thing I probably see in the marketplace today. And I see quite a bit of denial. I think people are like, well, it'll be okay because it's always been okay the last 12 years. So that's pretty much what I would put out there. There's a lot of things going on in the world. I wish we all got along better, honestly, but I can't change that. I just have to do what we do. I know we do a lot. We give a lot back to the community. I think that's a lot of what you should do in the world. But that's about all the advice I could give anybody.
Ted Oakley, founder and managing partner of Oxbow Advisors. Thank you so much for being so generous with your time, all of your knowledge, your wisdom. You are always welcome on this show. We love having you on. Thanks again, Ted.
You bet, Julia. Good to see you again.
You too.